Hello and welcome back to followers of the Casper journey. Today we're going to be having a look at Casper versus global liquidity and having a look at how global liquidity affects the price of Casper, as well as a few other assets, and comparing the correlation of global liquidity to the change of price in Casper versus other assets, and how reliable of a predictor that global liquidity is for the price of Casper. So before we get into it today, guys, don't forget to like and subscribe, and also to turn on post notifications so that you don't miss any of my future videos. So to really understand global liquidity, you have to understand and look at the world debt. So currently, the debt to GDP ratio of advanced G7 economies is around 350%, and there's around $350 trillion of debt in the world economy. And this has been on a steady rise since the 1980s, as you can see in this chart. And with the rise in global debt has been a decline in investment. And now this might be a little bit counterintuitive, because you would assume that if global debt is rising, then that debt is going towards investment and growing economies and going towards future growth. But the problem is that global debt has become so high that it is now adversely affecting future investment and capital investment, and is essentially acting as a burden on world economies. And this really can be explained when you look at the annual growth of world GDP. So this is a graph of annual GDP from 1961 to 2023. And you can see it averages around 3 to 4% per year. Obviously, it has swings with recessions and also up periods, but it generally sits at around 3 to 4% per year. And so to understand this, you have to think that if an economy is growing at 3% per year or 4% per year, and the world economy is growing at that rate, then that is the level of wealth increase that you would see in the economy if there was no debt in the economy. However, because world debt is at around 350% of GDP, then even if you have interest rates at 1%, then that debt is still growing at a rate of 3.5%. And so if the world economy is growing at 3.5%, and also world debt is growing at 3.5% due to the interest charged on that debt, then what that essentially means is that the entire growth of the world economy is going towards just servicing debts. And nobody really is able to enjoy the growth of that GDP because it is purely going towards the servicing of old debts. And so because debt is never really paid off in the economy and it really continues to grow and grow, however, the old debt does have to be paid off, and that generally is paid off with new debt. And so the average maturity or average lifespan of debt in the economy is around 3 to 5 years. So every year there's around 70 billion of debt that has to be rolled over and refinanced. And essentially the old debt has to be paid off with new issued debt. And in order to raise the amount of liquidity that you need to service the old debts that are rolling over every single year, you basically need balance sheet capacity. So with the average maturity of debt being 3 to 5 years, that therefore means that the amount of balance sheet capacity and also loan creation every 3 to 5 years has to increase. And so this essentially gives rise to a 4-year global liquidity cycle, which is measured by the global liquidity index, which we will talk about a little bit later. And so you can see since the start of this graph in 1968, every 4 years, the global liquidity, which really is new loan creation and balance sheet capacity, rises and then falls in line with the refinancing and servicing of old debts. So global liquidity is a measure of balance sheet capacity, or in other words, the capacity of capital. And what that essentially means is the ability to create loans at any one point in time. So if there's a high amount of loans being created and a high amount of new debt being issued, then that means global liquidity is on the rise. And if there is a low amount of new debt being issued, then that means global liquidity is declining. And so that balance sheet capacity or new debt issuance comes primarily from private sector lending, but then also central bank lending and central bank new money creation is also a big part of it. And that part is growing larger every single year. And so you can see the year-on-year change of the US dollar monetary base quite closely tracks the global liquidity index. So there's a number of different definitions of the global liquidity index. Different firms use different measures, but generally a relatively simplistic global liquidity index would be measuring the change in the money supply or the change in M2 in the system. And so when you look at global monetary liquidity, which essentially is the change of M2 as a year-on-year percentage change, you can see that it tracks a relatively clean and relatively cyclical 4-year cycle. So every 4 years, there is a rise in the percentage change of M2 in the system, and then a subsequent fall in the percentage change. And that doesn't mean the amount of M2 is going down necessarily. It just means that the rate of new M2 or new money creation is falling. And so because liquidity and increased lending and also growth in M2 is essentially monetary debasement and essentially a form of money printing, this means that global liquidity is also a huge driver of assets. So this is the S&P 500 year-on-year percentage change versus the global monetary liquidity year-on-year percentage change. And you can see that generally when you get a spike in global monetary liquidity, you also get a corresponding spike in the year-on-year percentage change in the S&P 500. And the same is very much true for gold. So when you get a rise in global monetary liquidity, you also get a rise in gold. And of course, these relationships are never one for one because there are other factors in the market that cause prices to change. But overall, there is a pretty strong correlation between global monetary liquidity and also the price of assets. And the same is very much true for Bitcoin. And you'll notice with Bitcoin that when global M2 starts to rise, Bitcoin also starts to rise. But when you compare that to the chart of gold or the chart of the S&P 500, Bitcoin has these huge spikes to the upside. And this really is down to the multiplier effect. So Bitcoin has a roughly 4.5 multiplier effect to global liquidity. So that means that if global monetary liquidity rises by 10%, then the price of Bitcoin will rise by 45%. At least that has been the historical correlation. Likely that will come down, but historically that has been the correlation, whereas gold has a correlation of more like 1.5%. So when global liquidity rises by 10%, gold will rise by 15%. And this can be seen slightly more easily on this chart here, where the correlation of global liquidity, which is the orange line, versus the MSCI World Index, which essentially is a stock market index, they have a very close correlation. And when you get huge jumps and spikes in liquidity, then you will also have a spike in the price of this index. And the same is very much true for the price of gold and crypto when compared to the global liquidity index. And you can see on the bottom here, this dotted line is the official rate of US CPI, so the official rate of inflation. And that is the inflation rate of basically a chosen basket of goods. Whereas, the arguably true inflation rate or the true rate of debasement and the true rate of devaluing money is the global liquidity index, because that is the creation of new money. And you can see the price of gold and crypto tracks that much more closely versus the official US CPI numbers. And the same is very much true for Bitcoin. So when you get a spike in global liquidity, the price of Bitcoin also spikes with that 4.5 multiplier effect. And then when you get a fall in global liquidity, that generally tends to correspond with a fall in the price of Bitcoin. And so you can see from this chart that when measured on a 12-month period, that Bitcoin is the most directionally aligned with global liquidity, so the most affected by changes in global liquidity at 83.2%, and then shortly followed by the S&P 500, and then gold lagging slightly at around 68.1%. And it has to be noted that overall world wealth and global liquidity are, over time, becoming more and more correlated. So, during the 1980s and 1990s, the correlation between global liquidity and world wealth was at around 0.57%. So, while it was still very important, and there was certainly a positive correlation there, it wasn't a particularly strong correlation, meaning that really the price of assets was driven by global liquidity, but there were also many other corresponding factors which went into driving asset prices and into driving world wealth. Whereas you can see really after the 2000s, the correlation has increased from 0.57 to 0.84%. So now, arguably, since that period, global liquidity is now the most important thing in driving world wealth and in driving asset prices. So it's one of the main key indicators that you need to watch if you want to know directionally what is the price of assets going to be in the near term. And so, Bitcoin really is a barometer of global liquidity. It is one of the most sensitive assets to global liquidity. So you can see here in the global M2 year-on-year change, when that has a spike and when that is increasing, the price of Bitcoin is corresponding and also increasing. And then when this global M2 year-on-year percentage change has a downturn, the price of Bitcoin also has a corresponding downturn. And whenever M2 year-on-year goes negative, that is generally a good indicator that the price of Bitcoin is basically bottoming and is coming to a low. So global M2 year-on-year percentage change is one of the best indicators for trying to pick out the Bitcoin bottoms. And if you can, correctly predict the bottoming of global M2, then you also have a pretty good chance of predicting the bottoms of Bitcoin. And the same is true for the price of gold. However, arguably, the price of gold is quite a lot less correlated with the changes in M2. So, for example, with this spike in M2 here, that did, pretty correctly predict a high in gold here. And then with the bottoming in M2 here, that did very nicely predict a relative bottoming in gold. The bottom came slightly later in gold in December 2015, whereas, the bottoming in M2 was slightly earlier in sort of April. So it was around 6 months out, but, that's not a bad predictor on gold, which, really should be seen as a long-term asset. But then, for example, here in this big spike in M2 in 2017, while it did predict an uptick in the price of gold, and gold did correspond by increasing in price, it didn't put an all-time high in from that prior all-time high. So, directionally, it's pretty good, and it can predict which direction the gold is likely to be going in. But arguably, it's less accurate at predicting the future price of gold, with the price of gold in this period, January 2018, being lower than it was in September of 2011, even though the amount of M2 global liquidity in the system was at a high at that point. And then once again, the uptick in M2 in 2019 and 2020 did once again predict a increase in the price of gold. But, for example, in this instance, the value on the global liquidity index was at 83.23, which, for that time was an all-time high. But down here in 2011, the amount of M2 global liquidity was 46.2. So, the amount of M2 almost doubled between 2011 and 2020, whereas the price of gold was basically staying the same. So, directionally for gold, it's a pretty good indicator, but in terms of predicting levels and prices, it's arguably slightly less accurate. And then once again, there is a pretty strong correlation between the S&P 500 and changes in global M2, with global M2 being relatively good at predicting sort of local highs and local bottoms, generally being sort of around 6 to 12 months out, especially when you're looking at the index versus the actual price. So for example, if we put the M2 global liquidity index onto the S&P 500 chart and we try to overlay it, then you can see that it is extremely accurate at predicting the highs and at predicting the lows. And that generally, when you have rising liquidity, you're also going to be getting a rise in the price of the S&P 500. And so one quite interesting thing to note about gold versus Bitcoin is that gold generally leads Bitcoin, and sort of rises in the price of gold generally predict a future rise in the price of Bitcoin. So for example, here in August 2018, that was basically the bottom in the move on gold, and then the bottom came around 6 months later in Bitcoin in December of 2018. And then the same was roughly true in 2020, with gold hitting a local high in sort of August of 2020, and then the peak came around 9 months later in April of 2021 for Bitcoin. So, gold in that case was very much leading Bitcoin. And, arguably they've been a little bit more correlated recently. So, the bottom came for gold in September of 2022, whereas the bottom came in November of 2022 for Bitcoin. So that was a lead of around 2 months. But so what that indicates is that this breakout in gold is predicting a future breakout in Bitcoin, and that gold is likely leading the price of Bitcoin as it has done in the past. And the same is roughly true for global liquidity or global M2. It generally has around a 10-week lead compared to Bitcoin. So changes in the amount of global M2 tend to lead changes in the price of Bitcoin by around 10 weeks. And so what that indicates is that likely, in correspondence with the rise that we have had in global M2 recently, that will likely correspond with a rise in the price of Bitcoin in the coming weeks to months. And so now really the question is, how much is Casper affected by global M2 and changes in global M2? And so really there's two things to note here, is that obviously we don't have anywhere near as much price data for Casper. We only have around 2.5 years of price data. And also the fact that Casper is, a much, much lower market cap asset, the less likely it is that you are positively correlated with M2, because a much smaller amount of funds flowing in can affect the price much more easily. But even so, when we have a look at Casper versus M2 and the changes in global liquidity, In this move here in July of 2020, the price of Casper was moving up and going parabolic basically, whereas the M2 Global Liquidity Index was moving down for this entire period. And then, the bottom in October for Casper did come relatively soon before the bottom that came in global liquidity. And then Casper did rise with this uptick in global liquidity. But then after that period when global M2 and global liquidity was rising, the price of Casper was falling for that entire period. And then conversely to that, when global liquidity started falling, that was actually when the price of Casper started to rise. However, the little dip here and the local bottom in M2 did correspond quite nicely with this minor dip that came in Casper, and then the corresponding rise in M2 did also correspond with the rise in the price of Casper. And then the subsequent sell-off that came in Casper did also correspond with a falling M2 Global Liquidity Index. So, you can kind of have a look at this, and I'll link this indicator down in the comments so that you can have a look for yourself. But while there is definitely some correlation between Casper and the global M2 liquidity index, there is also a relatively high degree of uncorrelation, and Casper can often rise while global liquidity is falling, and it can occasionally fall while global liquidity is rising. And so when you plot the correlation with global liquidity, and this is not on a 12-month basis, which is why it differs slightly from the chart we saw before, you can see that the S&P 500, Bitcoin and gold all have a relatively high correlation, whereas Casper does have a relatively high correlation at 0.67, but a much lower correlation compared to these traditional assets, which means that clearly global liquidity is important and it is a factor in the change in price of Casper, but there are obviously other factors at play here as well. Much like the correlation between global liquidity and world wealth before the 2000s, the correlation was 0.57. So, there was a correlation there, but there were clearly other factors. Well, the correlation between Casper and global liquidity is 0.67. So Casper is more correlated than world wealth was prior to the 2000s, but it is clearly not as correlated as the 0.84, extremely strong correlation that other assets have. And this intuitively makes sense because the correlation of daily returns with Bitcoin, most other assets are extremely correlated, with Ethereum at 0.8, and then the higher market cap projects such as Binance, Solana, and Dogecoin all having correlations of sort of above 0.6, but then Casper has an extremely low correlation at 0.2. So that makes sense, because if Bitcoin is highly correlated with global liquidity and Casper is highly uncorrelated with Bitcoin, then that also indicates that Casper is going to be less correlated with global liquidity. And so, overall, Casper is one of the least correlated assets with global liquidity, which indicates that Casper's price action thus far has been a result of organic adoption rather than global liquidity. And there have been many other factors other than global liquidity which are driving the price of Casper. And it also indicates that rises in global liquidity may affect Casper less going forward, and thus Casper may underperform some other assets in the coming liquidity upswing, which are more correlated with global liquidity. But it also reinforces the theory that Casper may well outperform in the bear market and be less affected by a liquidity downswing. Now, it should be noted that as Casper grows in size and in market cap, the correlation to liquidity will likely increase. But basically, for now, global liquidity is a relatively poor predictor of Casper's price action, and potentially a better model currently is the power law, which currently has a correlation of 0.9527 or a 95.27% accuracy. And so this here is a comparison of the historic price of Casper, so essentially a bars replay of Casper's historic price action versus the M2 Global Liquidity Index. So you can see that sometimes when the Global Liquidity Index is going down, the price of Casper is going up. And occasionally when the Global M2 Liquidity Index is going up, Casper is actually trending down in that scenario. And you can also see in this infographic the R squared of the Casper power law, and you can see currently here it's at sort of 0.84, 0.85, but basically as we get more and more price data of Casper, the R squared and the accuracy of the power law has also been increasing, and the percentage confidence that we can have in the Casper power law increases as we get more price data from it. So what I think this really shows is that while global liquidity is useful and it can be a predictor of Casper, overall, I think the power law is a better model for the growth of Casper, and it indicates that while global liquidity is important for driving the price of Casper, there are other, I would argue, more important factors like the organic adoption that we are currently seeing in Casper. And I think overall it's actually extremely useful to have an asset that is as uncorrelated to global liquidity as Casper is, because it essentially unlocks a new potential asset class. Because if all other assets are correlated with global liquidity, then really there's only one real trade. Whereas with Casper being so uncorrelated and really having its own unique price action and its own unique adoption curve, I think that makes it extremely attractive for really any portfolio. And if this uncorrelation does continue, then it will be more and more on the radar of money managers and hedge funds. So overall, I think that makes Casper an extremely interesting and an extremely unique asset to hold. So let me know what you guys think down in the comments. But other than that, thank you very much for watching. And again, don't forget to like and subscribe. And until next time, cheers.